Welcome back to Global Business Report. Nigerian equities market recorded a marginal growth last week as the NSE All-Share Index rose by 0.03%, closed at about 29,628 units, while market capitalization ended at about 15.262 trillion naira. All other indices finished lower, with the exception of NSE Premium, NSE Pension, NSE Insurance, the NSE Oil and Gas, and of course NSE Lotus 2 and NSE Industrial Goods Index as well. Joining me to discuss the effect of an increase in cash reserve ratio on Nigerian equities and others in fixed income market as well is Jerry Nnebue, an analyst from Cardinal Stone Research. Jerry, it's good to have you. Morning.
Good morning.
All right, so let's take a look at the marginal growth, no doubt, last week. But what drove this scenario, you think?
Yeah, I think it's just a continuation of what we've seen in the equities market since the beginning of the year. So, I mean, we've always talked about the fact that a lot of liquidity in the system, and that has really driven demand, speculative demand for Nigerian stocks. And that's, again, in itself is a continuation of what we've seen. The fourth consecutive weekly gain in the market, although last week it was a bit weak, 3 basis points, but then again, it still shows the strength of demand-induced, liquidity-driven transactions in the Nigerian equities market.
Very good, liquidity-driven. So how can such momentum be sustained?
Well, so it's one of two things. Firstly, I mean, you want to see investments in stocks that come from a point of view of confidence, improve sentiment in the ability of those corporates to do well in the economy. That is one. And then you're also looking at it from the angle of there's so much money, I don't have any place to put it in, so why not just buy stocks? I think what we think for us it's more sustainable is, demand that is driven by improvements in sentiments, improvements in the business outlook, improvements in the overall macro story of the Nigerian economy. That in itself is more sustainable than liquidity drive. So what happens if tomorrow the liquidity goes away? You see a lot of sellers in the stocks, and that's not very good for the markets.
Indeed, you're right, Jerry. So let's take a look at fixed income markets. How have they fared in your expectations in the week?
Yeah, I mean, we've seen some bullish run in the fixed income market recently, again, still driven by excess funds and chasing, not so deep fixed income market, especially in the bond and the T-bill space, following, the CBN's decision to bar non-bank corporates and individuals from playing in that space. So yes, we've seen some demand. However, if you look at the CRR move that was made last week,
supposed to come into that.
Yeah, so there's some likelihood that you probably see some, traders adjust their moves in the markets just to accommodate, the implications of that particular move.
Very good. And can you give us more insight on how an increase in cash reserve ratio, the CRR you just mentioned, will affect banking stocks and fixed income markets at this rate? And of course, CBN's role in all of this activity so far?
Yeah, I mean, beginning from the fixed income part, like I said, there's a lot of cautiousness. I mean, you're seeing trades begin cautious this particular morning. Although there's a likelihood that there will be an inching up of yields. But then again, the big question is how sustainable will the inch up in yields be, because there's still a lot of formal maturities expected. So the worries of yields going up is just, due to a potential tightening. But then again, with more and more maturities coming in, the system still being awash with liquidity, a lot of questions. It begs the question of how sustainable inching up in yields would be. But if you look at the potential implications for banking stocks, I think that's where the big one. So it has more of an impact for banks. I mean, no one saw this coming, really, because this is the first time the CBN is moving the CRR since 2016. And if you look at it from 22.5% to 27.5%, most banks are already above that. I mean, the average based on CBN's data is at 29.4%. Some of the banks we've spoken with, they are saying the average, the CRR effectively ranges from 27% to 35%, so that's really high. But the big question is if the CBN is going to apply the bank's current position against, what it's asking them to do. So the CBN is saying, I want 27.5%, but the bank comes and says, well, I'm at 28%, so I'm free to go. The big question is, will the CBN allow that? If you look at historical precedents, when the last time the CRR was raised from 20% to 22.5%, then effectively CRR was as high as 23.7%. Irrespectively, the CBN had to apply the increase against the bank's position. So what we expect or we foresee happening is that irrespective of the bank's effective positions right now, the CBN will still apply the extra 500 basis points in cash reserve requirement to banks. And by estimate, that's...
But do you think that will hurt the banks in any way?
Yeah, so by estimate, that would take about 800 billion, above, in excess of 800 billion from banks and books. And if you look at that, so you have the requirement that banks have to lend at least 65% on the one hand, and on the other hand, they are also containing or restraining banks' ability to fulfill that particular obligation by taking away their liquidity. It's a lot to ask for the banks, actually.
Yeah, and how to juxtapose between both instructions?
Yes, it's like pulling from two different directions.
Indeed.
And, the banks will be the ones to have to decide how to play it out.
Yeah, there's a lot of resilience in the banking industry, no doubt, from what the CBN requires. Especially last year, we saw how that is transforming into realities, current realities at the moment. Now, let's take a look at the 2020 Outlook reports. What are your thoughts here?
Yes, so you can look at it from different directions. The Outlook report was released, and we talked about trading on charted waters, which really is what we're doing in Nigeria, because we're trying to... The key theme has always been growth. How do we stimulate growth, sustainable growth? Nigeria has not grown in these levels for a very long time. We're at 2%, 2.2%, and then our projection, we should be doing 2.4%.
Yeah.
If you look at what we've done in terms of growth over the last pre-recession, we've been growing at 5, 6, 7%. Look at our peers in Africa, Ghana and the likes, they're growing at 5, 6, 7%. So the big question is what's going on with Nigeria. And I think that is the question everybody is trying to answer, both the federal government and also the CBN, the monetary authorities as well. And that is part of the reason why we saw a lot of measures, structural measures come out last year. We saw the closure of the borders. We saw the CBN, trying to induce banks to lend by stipulating a minimum loan-to-deposit funding ratio. We saw the CBN, splitting the fixed income markets into two, just to drive yields lower, on the domestic fronts to stimulate a lot of economic activities. It's still a very big question, lending, but then again, so this year we expect a build-up to all of those. We expect the impact of the border closures to begin to reap some rewards. We expect improvements in harvest to support the agricultural sector, which is the mainstay of the Nigerian economy. We expect improvements in oil production. All four of these are very, very key and vital to growth. Part of our worries, the expected increases in inflation rates, and that in itself is likely to be driven by, first and foremost, we've seen it being driven by the closure of the borders. We've seen it driven by excess liquidity in the system. We've seen it driven by...
But to a large extent, when you take a look at this, Jerry, is it possible that all these measures, like some of those measures that you've just measured, in the medium term, can we begin to see the result?
So that's the expectation, because you wouldn't be,
it's one thing to, promulgate all of these measures, but then again, real-time issues, real-time data, real-time results should be gotten as well.
We expect to see that. I mean, I'll pick the border closure, for example. So most of the usually imported, products, that have come into the borders. These are some of the things that can be made here in Nigeria. So if, by H2 2020, we're seeing some of these things being produced in Nigeria, that is good for economic activity, especially for, the informal segments, of the economy, which is very good and vital to growth. What we also need is, consumption that is, consumption-driven growth. So we're not saying that because a lot of talk about inflation, so much money in the system for inflation, but then again, we think that inflation is mostly supply-side driven. But we want to see consumption-driven growth. So a catalyzing of economic activities, fast implementation of capex. Now we've seen the budget cycle January to December. So if the government begins to implement, from January, again, we're seeing accelerated implementation of capex. That in itself can catalyze the domestic environment. So we're not expecting that at the end of the year we'll do 3%, 4%. But then again, these are building blocks. So it's a longer-term story, and that's the question that everybody's asking. So what's Nigeria's long-term story? So if you say that at the end of 2020 you want to see 5% growth, what should you be doing today that can, bring about that particular objective?
Very good. And if we go back a little, beyond the banking stocks, as usual, which companies or stocks, as it were, weathered the storm between the beginning of the year and now?
Well, we've seen, we are seeing some, apart from banks, we're also seeing some interesting names in terms of Dangote Cement, in terms of Nestle as well, because these are, in terms of their business propositions and positioning, there's some degree of resilience in what they have to offer, especially to the serving investors. So yes, we've seen some interest in those particular names as well, apart from the usual banking names everyone is interested in.
All right. Amid all of this scenario, what is your outlook for this week? I know it's still the first day, but we can just, think about one or two things and give a slight prediction.
Yeah, outlook this week. First and foremost, you probably see some initial reaction to the CBN CRR for banking stocks. I mean, general expectation is that, this may have negative implications on banks' earnings because banks have to start looking for funds at higher costs. So yes, we may see some cautious trading in banking stocks at the beginning of the week. But eventually, I guess investors will get used to the story as being the new normal for banks, and then probably see them come back in.
Just a one-off question here. Do you think banks have been highly innovative on account of this retinue of policies by CBN, a wave of, since last year?
In a way, it's going to foster innovation of, for the banks in terms of how they go about their businesses. Yeah. But then again, it's a flurry of all of those measures. So sometimes it can cause banks to wobble. But at the end of the day, I still expect that one or the other banks will find their way out of it.
Very good. Nnebue, analyst at Cardinal Research. Always a pleasure having you.
Thank you very much.